In this video, we are going to do the basic discounted cash flow exercise. Since for most of you this would be the first time, we will not be probably questioning the assumptions which are given here in the sheet. However, we will look at this sheet from purely mechanical point of view. So understand that growth rate assumptions or percentage sales assumptions or maybe other assumptions on capital expenditures we may be able to change once we have more understanding about the industry. But at this stage, we will not be assuming that growth rates or these assumptions have to be very concrete. So let's do the discounted cash flow exercise. We will be looking at DCF synthesis without solution sheet, and we will be navigating this sheet one by one. In this working sheet, we have three tabs. We have the projection free cash flow to the firm, we have the cost of capital calculation sheet, and we also have the capital structure calculations sheet. The first thing that we will target is the projections free cash flow to the firm. This is the sheet that we will do first. Number 2 would be capital structure calculations, and then number 3 would be cost of capital calculations. All these three sheets are interlinked, and we will do it one by one. Now let me explain you what this sheet has to say. There is a company ABC which is given to you, and you have 3 years of historical data. As you can see, December 07, 08 and 09. Okay, so for the moment, you may assume that these numbers are maybe historicals. Now in this example, what we are given is company ABC. Company ABC has reported 3 years of financial data, and its year closing is in December. So what we have is 2008, 2009 and 2010 data. Now the thing is that in free cash flow to the firm, let's have a look at what this formula has to say. Let's go back and look at this row number 58. Starting from 62 till 66, this is the formula for free cash flow to the firm. Free cash flow to the firm says it is EBIT into 1 minus T. You need to add the depreciation, less the capex, and less the change in working capital. The sum total of these four will give us the free cash flow to the firm. Now if you remember our discussion from the valuation module, free cash flow to the firm discounted value is found not for the historical free cash flow to the firm, it is found on the forecasted values. So here we need to have these forecasts. Will the management give us these forecasts? I mean, I really doubt, except for few numbers here and there. You will not be provided with the forecast of 11, 12, 13 or to an extent or the detail which you require. The management will surely not share that with you. So at the end of the day, you need to find out or forecast these set of assumptions or these set of numbers, because you want to do a projected free cash flow to the firm on which you can discount it to find the intrinsic value of the company ABC. So this is what we are going to do. Forecast all these individual set of numbers one by one. So if you look at this line number 62, earnings before interest and taxes. Now earnings before interest and taxes, if we have to arrive at this number, we will have to forecast the top line numbers, cost numbers, and maybe the other set of numbers which come before this. So that is why we have been given this set of historical numbers. So at this stage, what we will be doing is we will not be questioning the growth rate assumptions that we have taken. All the growth rate assumptions have been given to you. You have to take it. We will just try to reconcile whether these numbers and your numbers and our numbers are correct or not. At the end of the day, this video will only give you the mechanical way of looking at discounted cash flows. Please remember that all the analysts will give you different kinds of valuation figures, and these figures may be different only because of the growth rate assumptions or other assumptions that may have used. The idea is that these growth rate assumptions can change depending on how deeply you understand the sector. Let's say if I am very new to an IT sector, information technology sector, the assumptions that I may be using will be very, very basic, because I don't have the in-depth understanding of this sector. However, if you may have spent more than 5 years or 7 years in this sector, you may have worked as a business analyst in one of the IT companies like Microsoft, you would be in a better position to comment on the health of the company and the direction of the products and otherwise. So that's why at this stage we will not be questioning the growth rate assumptions. So let's look at each line number one by one. Revenues for 2008 was given as 200, 2009 as 210, and December 10 as 225.